Hi, I'm Dean Mioli, Director of Investment Planning for SEI. Today we're going to talk about the Tax Reform Bill, also known as H.R. 1. There's been a lot that's changed, and we're going to cover that at a very high level. And we're also going to cover action items and other considerations. Let's talk about individual tax rates. We had 7 tax brackets in 17. Guess what? We have 7 tax brackets starting in 2018. Well, when you look at these brackets, what we'll see is that most taxpayers, their tax rates are coming down. Let's talk about the alternative minimum tax. There was a huge change here. One is the exemption amount increased significantly from 17 to 18. And even a bigger deal here is that the phase out of the AMT exemption is now much higher in 2018 than it was in 2017. What does that mean for most taxpayers? Well, what it means is that most people will not be paying alternative minimum tax anymore. The second thing is the standard deduction was doubled for taxpayers from 17 to 18, and personal exemptions are no longer deductible starting in 2018. What that means for most taxpayers is that they will not be itemizing. In fact, most taxpayers weren't itemizing to begin with, and now with this new tax law change, even more taxpayers will not be itemizing. So they'll have a simpler tax preparation. Let's talk about itemized deductions. There were huge changes here for individual taxpayers. One of the big changes is now we have a limitation on the amount of state and local and real estate taxes that you're allowed to deduct. For a married couple, that's $10,000. On top of that, there was a change where there used to be a phase out potentially for itemized deductions. That has gone away in 2018 and forward. Also, most miscellaneous itemized deductions that were subject to 2% of AGI means adjusted gross income, will no longer be allowed. And they include such costs as tax preparation, investment expenses, and job-related expenses. And we'll talk about some planning about that a little later. Now, there hasn't been any change to the capital gain and qualified dividend tax rate. Let's talk about mortgage interest. In 17, you were allowed to deduct up to $1 million of primary and secondary residential mortgages. And you were also allowed to deduct up to $100,000 in home equity line of credit, also known as HELOC. Now, starting this year, 2018, the limitation on mortgage interest is now $750,000 for primary and secondary residences. Pretty significant decrease. And going forward, HELOC interest is no longer deductible. Let's talk about the child tax credit. In 18, there was a significant increase in the amount per child from $1,000 to $2,000 per child, and $1,400 of that being refundable. The phase out has increased significantly, so more taxpayers will get the full benefit of that child tax credit. Let's talk about investment taxation. Even though we had a major tax law change, the biggest expense for investors is tax. Now, starting in 18, the top tax rate on ordinary income, short gains, and interest income went down from 43.4 to 40.8, but that's still high. There is tax favored income, which is qualifying dividends and long gains. That'll be taxed at 23.8 at a top rate. And of course, municipal bond interest remains federal tax-free and potentially state tax-free. And of course, if you don't sell anything at a gain, unrealized capital appreciation, of course, is not taxed. And as an investor, you should be focusing on after-tax returns. Now, one thing to do to minimize your tax bite is to understand not only your asset allocation, but also where your assets are located. Asset location. And here we have a priority list. Now, there are certain asset classes that are quite tax efficient, and certain asset classes, like commodities, which are generally very tax inefficient. So when you're planning out your asset allocation across different accounts, you might want to bury your tax inefficient asset classes in, for instance, your 401k and your IRA accounts, and your tax efficient asset classes like municipal bonds in your non-qualified taxable accounts. Okay, if I was an advisor, here are some of the things I'd be considering discussing with my clients. One is absolutely asset location matters. Where you own your assets it's important to increase that after-tax return. Investors in the 32% or higher tax bracket should consider municipal bonds for their non-qualified accounts. Remember, tax loss harvesting is a year-round exercise. Mutual fund capital gain distributions could again be large in 2018. We're going to need to monitor that closely. So let's talk about something. You as an advisor, you may get a question from your client. I read that in the new tax law that investment costs are no longer deductible. What should I do? Well, if I got that question, I'd have to look over their client accounts. And I might, as an advisor, recommend that if I normally charge $10,000 to manage their portfolio, and they both have a non-taxable account like a Roth or a tax-deferred account like a traditional IRA and a taxable account, I may look to separate my fees. And what I mean by that is have the traditional IRA account pay their own investment costs. Never, ever pay investment costs, if possible, out of a Roth account. Now, granted, what we're doing here isn't going to change the tax deductibility of this expense, but we are now going to be using pre-tax money to pay an after-tax cost. And that's a tax-smart idea. Food for thought.